Should you go for higher capital growth for your first and next investment property? Or should you go for higher cash flow property when you're considering your next purchase? This is one of the top questions which we get asked from our clients in their strategy session. And today I'm going to lift the curtains from the exact formula and the numbers which we use for ourselves and for our clients in the property journey. If that sounds like your cup of tea, stick around. And make sure you watch this video until the end, because today I'm going to discuss some of the important tips which you should consider when you're buying your next purchase. Hi guys, this is John from Admire Property Group. I'm running an independent buyers agency where we help our clients in acquiring high performing real estate asset, which grows faster in value with time and which gives a good rental income and cash flow, basically making it self-sustainable investment that doesn't put a lot of pressure on your finances and eventually navigates you to the financial freedom. And welcome back to another episode on this channel where I talk about financial independence, financial literacy, real estate, and passive income. And if you are new to this channel, make sure you like and subscribe so that we can circulate this video to more viewers who are considering investing in real estate. So let's start with the capital growth. So capital growth in real estate refers to the increase in value of your investment over time. It is basically the difference between the purchase price of your investment and its market value at a later stage. For example, if you buy a property of $400,000 this year, and after 2 years, the market value of your investment becomes $500,000, then basically the difference of $100,000 is your capital gains or capital growth, and it is also known as equity. This $100,000 of capital gains is not accessible to you. If you want to access that money, you will have to consider two options. The first one is you sell your property, or the other one is use this equity for your next purchase. If you sell your property, you will get a profit of $100,000, but you will have to pay taxes on that. But if you consider using this equity for your next investment, then you can access that $100,000 and not pay any tax on it, because bank will consider this as a loan to you. You are increasing your debt and you can't be taxed on the debt. And if you want to learn how to use equity for your next purchase, you can pause this video and click on the link above or the link below given in the description to watch the video and come back on this video again. And on the other side, if you don't do anything and hold on to your property, it will keep increasing in value with time, provided you have bought in a good location with strong data factors. It is not guaranteed always. There are chances that your property may decrease in value if you haven't researched well. And these capital gains, are you able to access it fully? Never. You can access it partially. You can access 90% of the capital gains, provided you got the borrowing power. And if you are the one who is struggling with the borrowing power or is short by 30-40 grants in borrowing power for your next purchase, you can click on the link above to watch the video where I have shared some of the tips which will help you in increasing your borrowing power. If you don't have the borrowing power, you could have made $2,000, $300,000 of capital gains, but you can't access it, so you won't feel materially different. If you are thinking of making passive income through real estate, you will have to buy multiple properties so that you can finally start getting some passive income from it. So for that, you need the borrowing power. For the borrowing power, you need the cash flow. So here, the cash flow comes into the picture. So coming to the cash flow in real estate refers to the net cash which you get in your pocket from your property after subtracting all the expenses related to that property. So if you're getting money in your pocket, it is a positive cash flow property. And if you're paying money out of your pocket, it is a negative cash flow property. Positive cash flow property means like higher income, less expenses, and negative cash flow property is lesser income, higher expenses. And if you want to know more about positive cash flow properties and negative cash flow properties, I'll leave a link below in the description for you guys to watch that video later on. It is very hard to get positive cash flow property in today's environment because of the increased interest rate. But neutral and slightly negative cash flow property is a good position to be in. Cash flow is considered as a king. For example, if you have bought a property of $500,000 and it is giving you 5 to 6% rental yield, and you are making $5,000 in passive income from that property, and out of making $100,000 as a passive income. So how many properties would you need? You would need at least 20 properties to get to your target. And if you are making $50,000 deposit for one property, then you would need $1 million to buy those 20 properties. And how many of us have got $1 million of saving in the account so that we can start buying the properties? And even if you have got that much money in your account, then also you need the borrowing power. And if you are totally relying on cash flow from your investment property and you want to go for a next investment of $500,000, you would need a deposit of at least $50,000. And from that passive cash flow of $5,000, it will take another 10 years to save $50,000 as a deposit for your next investment property. But if you have got the capital growth from the same property of $100,000 in a year, you can use that equity and buy your next investment next year. So you need a balance of both capital growth and cash flow. You need extra passive income as well as capital growth to move up on the property ladder. Otherwise, it becomes impossible to keep growing your property portfolio. Consider capital growth as a machine or engine and as a fuel. If you go for capital growth, you have got the machine but no fuel. And if you go for the cash flow, you got the fuel but no machine. You need both of these to go further, and use equity and cash flow simultaneously to keep buying more and more asset and acquiring more assets to increase your portfolio. I have seen a lot of people investing in CBD areas where they are getting high capital growth, but they are getting highly negative geared properties because it saves a lot of tax for them. But consider spending $1 to get 30 cents, 40 cents, or 50 cents back is not a good strategy. Although you are getting a capital growth, but it's putting a lot of stress on your finances. Buying highly negative cash flow properties to save your tax will put a lot of stress on your finances and will take a lot of money out of your pocket so that you can hold on to those properties. What happens if interest rate keeps increasing, inflation keep increasing, and employment rate changes? You may face another recession or pandemic. It becomes very hard for you to hold on to those properties if they are all negatively geared properties. Surely negative gearing saves you a lot of tax, but you need a lot of money to keep on holding those properties. This will cost you thousands of dollars to keep those properties. We need to be able to hold on to these properties in case of unforeseen events, and we need the cash flow to face ups and downs of these interest rates and inflation, and we need the cash flow for borrowing power. Banks are also becoming very restrictive in terms of calculating their borrowing power, especially after 2017, 2018, when APRA came and made a lot of changes in the bank policies. And with today's environment, it's becoming very important for everyone to acquire as many assets possible because it's becoming difficult every year to go for next purchase. A lot of people are scared of getting a debt, but if you are taking a debt for an investment, you are taking a benefit of leverage of banks' money. And with the inflation, the value of that debt is decreasing every year. So you are taking a double benefit. For example, if you take a debt of $400,000 for a purchase of $500,000, the value of this debt will be a lot lesser as compared to the present value. The $400,000 in present will buy you more assets as compared to after 10 years. So going for a debt to take benefit of leverage of another money and making a balance of capital growth and cash flow can help you in achieving your goal faster. I have seen people going for capital growth as a strategy for their first investment and then cash flow for their another investment, so making the pairs. But the best strategy is considering those investments which have good capital growth as well as cash flow. So you need to optimize and make a balance between capital growth and cash flow. That gives you better value. Process of buying multiple properties seems easy, but it's very difficult. It's very difficult these days to find out a good property which will give you capital growth and cash flow. It needs a lot of research, state-wise, suburb-wise, area-wise, street-wise, and property-wise. And if you need any help in finding out the locations and these kind of properties which will give you higher cash flow and capital growth, you can give us a call. Our contact details are given below in the description. Hi guys, I hope this video has added value, and if it has, make sure you like and subscribe to the channel, and I will see you in my next video. Bye for now.